Assalamu alaikum. Welcome to video 11. This is IAS 20 government grants and government assistance applicable for both SBR and FR students. So, IAS 20 government grant. First, let us go through government grant and then we'll discuss government assistance because the way we account for these two are different. Okay, a government grant are any type of assistance by government in the form of transfer of resources to an entity in return for complying. Either in the past you have complied with certain conditions, or in the future if you comply with certain conditions, you will be eligible for the grant from a government. So a government assistance is action by government designed to provide economic benefit to a specific entity. That is a assistance. Now, accounting treatment. IAS 20 says grants are not to be recognized until there's a reasonable assurance that A. Conditions that are attached to the grant will be complied with. B. Grant will be received. So if these two conditions are met, you will recognize the grant. Now, grant shall be recognized in the statement of profit and loss as to match them with the expenditure towards which they are intended to contribute. Now, there are two types of grant. One is known as capital grant, that is towards the cost of the asset, and the other one is towards the other grant is income grant, towards the expenses. So first let us go through an income grant. Income grant given to subsidize expenditure has to be matched with the related cost. Income grant is given to achieve a non-financial goal such as job creation. So this should be matched to the cost that are incurred to meet that goal. Grant for purchases of non-current asset has to be recognized over the expected useful life of that related asset. Same like depreciation expense, how you recognize. Okay. Now, so there are two acceptable accounting treatment for grants that are relating to non-current assets. I told you there are two types of grant. One relating to non-current assets, other one related towards expenses. First, let us finish towards grant relating to non-current assets. There are two accounting treatments. First, either deduct the grant from your cost of asset and depreciate the net cost. Or second treatment, treat the grant as a deferred income and release it to the statement of profit or loss over the life of the asset. How you release depreciation or amortization, same way. Okay. Next, grants that become repayable. What if your grants become repayable? Now you have to pay back the grant back to the government. There are conditions. If you meet, you have to pay back. A government grant that becomes repayable, you have to account it as a change in accounting estimate. Okay. Example 1. An entity is receiving a government grant of 1.5 billion to subsidize the cost of employing people in areas of low employment over the next 3 years. Now, the grant should be matched to the cost in each year. Therefore, grant initially you have to recognize it as a deferred income, and each year 1.5 divided by 3, each year 500,000 has to be credited to your statement of profit and loss. It's an income and it will be offset against the related payroll cost. So this grant that you are crediting to statement of profit and loss will be offset against the cost, related payroll cost. That is the effect of the grant. Okay. Example 2. An entity is receiving a government grant of 0.5 million towards the purchase price of a building. First one was regarding a cost. Now this is about a non-current asset. So there are two ways. First, and the purchase price is 3 million. Useful life is 50 years and you are going to depreciate it on a straight line basis. So grant can be accounted for in two possible ways. See, this two possible ways is only when it's a grant towards the non-current asset. Okay, remember. For cost, it's only one way. You recognize it as a deferred income over the life of the grant. Now, reduce the cost of the building by 0.5 million, that is the amount of the grant, or the building will be included within property, plant and equipment at 2.5 million, that is 3 minus 0.5, and you will depreciate. Okay, so when you reduce the cost of the building, this is we are still in the first one. Sorry, I'm sorry. When we reduce it the cost, so cost becomes 2.5. This 2.5 you will divide by 50 to get the depreciation, which is 50,000, which you will charge each year for 50 years. Or the second method, you will recognize the grant of 0.5 million as a deferred income and you will amortize it over the statement of profit and loss over the useful life of the building. So what is the cost of the building 3 million. That 3 million you will divide by 50, depreciation will be 60,000. Okay. Next, you are recognizing a grant as an income. So 0.5 million also you will depreciate over 50, amortize over 50 years, which is income of 10,000, which you will credit to your statement of profit and loss. And the deferred income liability will be shown in your statement of financial position. Okay, which will reduce by 10,000 each year. It will keep on reducing by 10,000. Okay. So thank you for watching, and make sure that you do questions on IAS 20 on both the presentation and see whether you have understood the concept of IAS 20 or not. The next standard will be on IAS 21, that is foreign exchange. Once again, it's applicable for both SBR and FR students. Thank you for watching.